Good morning, everybody. Matt here. I'm going to give a quick, or hopefully quick, and hopefully somewhat organized marketplace update for the insurance market. I think we did one about a year ago for our team. Today's December 14th, 2023. This year has been a tough year in a lot of areas of our insurance marketplace. I'm going to do my best not to get on the soapbox politically with my views there, but we'll just go over what's actionable. So on the screen here, I just have a few topics to hit, very similar to what we did last year. I'm going to start off with personal lines. It's one of the hardest things right now to deal with. So we're going to go ahead and just hit that. Personal lines, you're going to have to realize there is not going to be a cheaper quote in most situations. So don't even use the word cheap. Everything must be packaged, and we have very, very limited market availability. Fortunately for us here at GDI, we do have CIG and a very strong relationship with Safeco. Safeco, effective 1/1, will be suspending or terminating access for new business or contracts in general to approximately 80% of their California agents. About 60% are going to be suspended for new business writing if they haven't already been. 20% will be terminated. And then the top 20% are what they literally put in writing as calling varsity players. Fortunately for GDI, we are a varsity player, and we are finalizing an acquisition of a small Bay Area book of business that's actually going to expand our new business writing abilities. So on paper, we're allowed one household package a month. However, we can write 5, 6, 7 of those. They just won't put written commitment to us, and we have to go through underwriting. We have to go through our marketing rep for approval on everything. CIG is our least restricted company right now. If they are willing to write, they are being very selective. And they're using any excuse known to man to not write things that they aren't super comfortable with. Their restriction is if you want to write auto or home, if you want to write auto, you have to have the home. But they'll write some unsupported dwelling fires and things like that. Other markets are the next best things like Mercury. Mercury has pretty much a 1-month delay. So if you submitted today, you're going to be January 14th or so, give or take a day, because I think it's a 28 or 30-day hold before they'll even release the ability to bind. So beware of that. If you must do personal lines, that's what you need to know. If you're having our team quote personal lines, it's not going to be multiple iterations of quotes. They're going to give you the best out the gate. Our standard limits are $250, $500 liability for auto, $500,000 on the home. We're going a minimum $350 a foot for reconstruction costs or the replacement cost estimator value, whichever is higher. We are doing $500 or $1,000 deductibles on autos and $1,000 to $2,500 on homes. We add every expansion endorsement to the home and the auto, so that's the platinum or whatever endorsement's appropriate, OEM parts, everything like that. We're not here to do low limits. We're not going to do it. It's if you look at the new business we're writing with the higher limits, the service load is less too, which allows us the ability to then remarket existing business to make sure we maintain it on the books. I'm going to go into, and the FAIR plan, get used to it. It ain't going anywhere for a while, and we're going to be stuck with it for at least another couple of years. From what I can tell, it's probably going to be end of 2025 before the personalized marketplace is going to get better. We have carriers that have 20, 30, and 40% rate increases that are pending approval for early next year, but it's going to take an entire year of renewals and new business to get all that rate into the system to then start seeing people ease up. But the carriers that are still writing, Safeco, CIG, and Mercury, are committed to continue writing. It's just they are doing so in a fashion that's not having them lose their shirt. Now I'm going to auto. Auto is a fun one right now, both personal and commercial. Commercial auto, if you're trying to do monoline, it is nearly impossible in many scenarios. You're going to have to wrap it up with property and equipment, and even then, most carriers are saying no now. Standalone markets are nasty. We had one client on 10-1 be non-renewed. They had a $182,000 premium with about 75 units on the fleet. Our best option in the standard marketplace was $610,000 as indicated by Berkshire Hathaway. We ended up having to go more creative. We got them into a group captive for their workers' comp, auto, and general liability, and the auto came in at $290. And those aren't the worst increases we've seen. If we can get rid of frivolous lawsuits, we can get rid of the fear of nuclear verdicts, things can change. But right now, auto, if somebody's paying under $3,000 per power unit, I would be hard pressed to see them beat that anywhere. A lot of our clients are paying 3 to 5, and some are paying $10,000 a power unit now for liability and physical damage combined. I'm going to go into property now. Property is a fun one. It started in personal lines when the fires were hitting, but now it's everywhere. We had one client mid this year. Expiring premium was in the mid 80s. Renewal premiums 248. Sounds great for commissions. It's not to the benefit of the customer. We had to go from admitted placement to E&S, and in E&S we have no loss of rents. Actually, correction, we have $1,000 one time as a loss of rents payment, and that's it. Whereas, I mean, their total monthly rentals are almost $250,000. So with property, we need every bit of detail. If a customer is pushing back on providing detail on updates, that should be a signal to you that they are not truly a prospect that is engaged and committed to the process, and they're probably wasting your time and whoever on our team is rating its time. Okay, property, there it is. You need every bit of safeguards. If they don't have it, you're not going to get anything pretty. And in the E&S market, if you get an E&S property quote, whether it's owner occupied or it's a lesser's risk with a tenant in it, if you do not have proof of current verifiable burglar alarm, you are not going to get theft coverage or malicious mischief on that building. It'll be excluded until you provide proof, and it is accepted as proof. Not just providing it, but accepted. So those are things you need to keep in mind. Excess liability is crunching down. Nationwide, we used to be able to get $10 million all day long as an excess for the lead layer. Then it got cut to $5 million a few years ago. If you can get a $2 million excess out of Nationwide, you just got God's gift for the year out of that carrier, probably for all of Northern California. Most of their excess now is $1 million, maybe sometimes $2 million. So you're going to have to get multiple tiers of excess in order to get that filled, and it's going to be more expensive. We have clients who are going from $2,000 to $4,000 for their $5 million excess. For us to get a full $5 million, they're paying $1,000 to $2,000 now for $1 or $2 million, and then that $3 or $4 million excess of the $1 or $2 is $5,000 to $10,000. And it's all out of the E&S marketplace, and nothing's really admitted. So that's there. Not all is doom and gloom, though. We're going to get into a light spot, and that's workers' compensation. Workers' comp is still at nearly an all-time low on rate per dollar of payroll. You are going to see premiums increasing because wages are increasing. But as a percentage charge on top of payroll, like a payroll tax, rates, as long as somebody's performing well, are flat, if not lower again. We have a pending 1/1 renewal. Next week we'll be presenting, and they're seeing out of multiple states they're in, California has the worst renewal offer, and it is 15% less on net rate. So they just had a 15% reduction in the rate this year, and that's after a 14.5% reduction last year. So compounded, they're well into the mid-30s on reduction. So workers' comp's that way. Do be cognizant of newer programs out there. We are starting to do a lot more in the group captive space with clients that are 100 to 150,000 in qualifying premiums. Group captive, you have to have workers' comp, and you can then it has to be agreed upon for auto and general liability. And we have clients that have all those lines in there. But what that does is it gets you away from your X mod, whether it's high or low. It doesn't even go into the calculation. They only calculate based on the business's own 5-year rolling history, what your audited payrolls were, what your claims were, what your class codes are, and that's it. So that's something to be cognizant of. If you have a client that you think might qualify for one of those, reach out to myself, Steph, or anybody else on the team. We can go over that. It's pretty quick and easy to get an idea if it's actually something that should be investigated. We can also do an internal what if 5-year look back to project what they could have potentially performed with. Because not only do they usually get better pricing, and we're talking 15+% better, they can get almost 2/3 of their premium back if it's not used for claims. So there's a lot of benefit in there. And some of our clients are really, they're raking in multiple 6-figure savings a year. Now, going into quoting and underwriting, if you haven't already felt it, as compared to those of us that have been in the industry, decades now, the requirement for information is higher than it ever has been. Even on workers' comp, they're asking a hell of a lot more information. So with that being said, do not push back on information needed. It is understandable to want to know why it's needed, but you are going to need it. Property accounts, you better have full COPE information. That's construction, occupancy, protection, and I can't even remember what the E stands for. And they're going to be spreadsheets. So those of us submitting schedules of properties, more than 1 or 2 buildings, and even many times with just 1 building, you're going to have a statement of values spreadsheet, and they can be fairly long. If you've done anything in the cannabis space or you've done anything in the stock throughput space, you've already been accustomed to these types of applications, but there is going to be a lot of information needed, especially updates. Updates is even needed for inventory that is on an inland marine form. We need updates on every location they're at, even if the location is an uncovered yard. So be ready for that. Quoting turnaround times are slowing down in commercial lines. Personal lines, we already know there's underwriting holes. So you're going to have that issue. Commercial lines, you're having issues there. Nationwide on the ag side has done something unique as of the beginning of this year. They are requiring a 90-day lead time for new business. However, if the 90 days ends up starting on the weekend when they're not open, they're not honoring our submission at day 88 or 89, and they won't accept it at day 91 or 92. So they've effectively shut down a big chunk of new business depending on the dates that you're submitting for. And they will not consider midterm stuff very often at all. Okay. Other underwriting things we've seen is your contracts and subcontract agreements, leases, things like that. It is becoming more and more, it's pretty much the norm to need to have those ready to go, especially in construction. You're going to need to have any subcontract agreement that they're having others sign who are working for them. Just get it there. Okay, carrier specifics. I mentioned group captives earlier. If you're not familiar with them, we have a white paper internally. We can just shoot over to you. It is able to be customer facing, so you can send it to them as well. You do need to be cognizant of those programs because not only we, but many other brokers are starting to use them. The difference between us and probably 75% of brokers out there that are actually talking about group captives is that they are using it as a defensive strategy because they don't want to move their stuff out of the traditional marketplace. And I get it. As an agency, let's say we get 15% commission on auto and general liability with Travelers. We also get contingency of 2 or 3% on the back end. Now, in a group captive, the minimum commission is 5.5%, and the premiums are lower. And your commission is not calculated the same. So, of $100 or $1,000 in premium, 15% commission is $15. In a group captive, your premium does not include commission. So really you're now charging yourself 5.5 or 10.5% for a fee equivalent of commission on 85% of the premium, or $850. So there is a cut in revenue. However, the workload, the claim service, and everything else far improves from our perspective. And our clients, the ones that go into these programs, typically are growing at above industry standard rate. So you end up making more money. That being said, we don't charge 5.5. Our minimum is 10.5 to 11.5, and we're looking at going to 13 to 15% commission now because we know what service is being provided. But from a producer and an account manager standpoint, aside from the first couple years of submissions for the initial submission and then renewal, there's very little work to be done on these. It's just us invoicing either quarterly and or annually. And then once they've been in for 5 years, the renewal submission requires 3 items. Estimated basis for general liability, which is usually sales, payroll by class code, and number of employees by class code and location for the workers' comp, and then an updated fleet list. There are no MVRs to run. There's no loss runs to get once they've been in there for 5 years. That's all we do. And then their audits are virtually, headache free every time. Other carrier specific items is state fund. Be ready to have use of it. So I'd mentioned workers' comp. It's a soft market still. It's going to change eventually. We are going to see a hardening. We've been seeing 3 and 4% compounded increases in claim costs across the state of California and the nation. We're going on 5 years of those. So if you just take 3 times 5, that's 15%. But that's not truly how it goes when you compound interest, right? Or compound cost and increases. So we're probably closer to 17 or 18% if I had to do the math in my mind. So what that means is that if the insurance companies have had these increases in costs, but yet our state of California insurance commissioner has mandated, this year he mandated the lowest decrease that he's done. And that was he wanted a 0.5% decrease across the board. But he's been mandating, they've been enforcing 1 and 2% decreases. So even if they just do 1% a year, that's going to compound after 5 years close to 5.5%. 5.5 plus the 17 or 18 before, you're looking at over a 20% disparity in profitability in workers' comp, and we just haven't seen that flow through yet because of COVID subsidies and the delay in care that had been happening. So during COVID, we had a few clients, knee surgeries were postponed 9 and 12 months from when they should have been done. Well, that means the expenses have been postponed for the insurance company 9 and 12 months, but yet that wasn't taken into account when the state required the reduction in rate. So those are some of the things to think about there. So State Fund, what's fortunate for us is we have direct access with them on a preferred contract. So we get anywhere from 9 or 10 on the low end up to 13 or 14% commission, depending on classification and size. One hiccup is once you're over $500,000 or $550 in premium, there is no commission with State Fund. We just negotiate a broker fee. Other carriers that are out there doing things, they're tightening up across the board. So we do have access to a number of carriers through Pacific Interstate Insurance Brokers, or PIIB's Accelerate program. Basically, it just means that since we don't have a whole lot of business with these guys, we're going to be able to still go to direct, but we're just rolling into their code, so we don't have to meet any production requirements. That way we don't have to rob Peter to pay Paul with clients between carriers. But that gives us Chubb. So we have Chubb Commercial, we have Chubb Ag, we have Hanover in there, and a few other carriers. If you need that list, let us know. We all share logins for those. And then just other miscellaneous things we have in commercial lines. We have Tarmica. If you're not used to it, you're familiar with it, it's included through Epic. And it's basically a comparative rater like we've had in personal lines for decades, but for small commercial and small workers comp. The only hiccup with that is you can't do multiple locations in there yet, but that's supposed to be coming out Q1 of 2024. So it's not all doom and gloom in our industry. It's actually a whole hell of a lot of opportunity. It's just now, insurance 30 years ago, people would be golfing 2-3 times a week for damn near the whole day, being an insurance broker or a banker. No longer are the days where you get to take a day off and go golfing twice, or take 2 days off a week to golf every week. We just have to do work. And what's nice is most of the other agents are still on that golf schedule, it seems. So we have more opportunity. Anyway, if you have any questions, concerns, comments, let us know. If you want help strategizing on a specific account, let myself, Steph, or anybody on the team know. All right, guys, best of luck going through the end of this year and into next, and we'll talk soon.